Good morning. This is a continuation of microeconomics. We started talking about supply and demand, chapter 4. We didn't get too much done, so what I might as well do is start from the beginning on chapter 4. Chapter 4 again covers supply and demand. Supply and demand is an interesting concept. It's pretty typical in economics. It's used to explain not only the actions of buyers and sellers in the marketplace, but it's also used in macroeconomics to define what occurs in the aggregate or national or total economy. So it's a very important concept in microeconomics and macroeconomics, therefore a very important concept in economics in general. So let's get started. You've seen this before, but let's go through it again. A market is groups of buyers and sellers acting together. Again, the buyers are the ones who are spending their money. The sellers are the ones who are receiving the money. This is the interaction of buyers and sellers. As buyers, we have consumer sovereignty in that we vote with our dollars on what products we want and what products we expect the sellers or producers to produce. And therefore, they will continue to produce those products for us, assuming, of course, it makes a profit for them. Okay, as we said, markets have two types, faceless and visible. The faceless is the rise of the internet. Amazon, stock and bond markets. Stock and bond markets are faceless in that you don't see who you're buying it from. You don't even get a certificate any longer. It stays in your brokerage account. So the stock market and bond markets are really completely faceless. All you can get is a statement that shows what you've got in your portfolio, how much you paid for it, and what the current price is. Visible market is the opposite. This is the one where we actually go to a physical place. Best Buy, Costco, Walmart, your local grocery store, your local cleaners, your local restaurant, your local donut shop. These are the people that stand behind the counter, take your money, and give you their products. So it's called a visible market. It's particularly dangerous today, or for some people, it's getting to be very difficult to do business in this market, particularly retail stores, clothing manufacturers like Best Buy, not Best Buy, but what the ones we've seen, JCPenney, Belk, Sears, all of them are in deep trouble closing stores because the internet has taken a lot of business away from them. Amazon continues to expand. For instance, now they're looking for a regional center, distribution center. I think Texas is being considered, Colorado, etc. So the growth has taken place in the faceless market as opposed to the visible market. Competitive markets. What do we mean by competitive markets? A competitive market basically has many buyers and many sellers, as opposed to a monopolist market. A monopoly, the monopolist has one product, he's the only supplier of the product, and he in turn can demand whatever he wants. Therefore, when we talk about demand curves, the monopolist owns the demand curve. But a competitive market, therefore, has many buyers and many sellers. We can think of these markets as just walk down a supermarket aisle and look at the different brands of soaps that we might have, not only bar soaps, but liquid soaps, soaps for laundry, soaps for dishwashers, etc. Very, very competitive market because there are many buyers and many sellers. We all buy those things, and there are many people that sell and offer those things to us. So, all markets have in common, make certain you understand this. Every single market has in common demand, supply, price, and quantity. those are critical to a market and how a market operates. Doesn't matter where the market may be, it's demand, supply, price, quantity. So how do we determine price? Well, it's really us that determines the price. The seller doesn't really control the market because there are many of them in there and he can't dictate the price that he wants. He can do it, but he may not do it and sell it at a profit. So we are key to determining price in the marketplace. What are we going to pay for it? I use the example of chocolate chip cookies. Again, the seller raises his price from $2 to $2.50 for a box of chocolate chip cookies. And as a result, I look at that and I say, I'm not going to pay 50 cents more. So I get down the grocery aisle and I look for another brand of chocolate chip cookies and or a substitution for sugar cookies. So what I am doing is I am determining the price at which I'm going to buy it. All right, so let's talk about the first concept, demand. What is demand? What does it mean? What does it represent? Demand is basically a curve or a schedule, and it depicts various amounts of products a consumer will purchase and at what price they will purchase over time, all other things being equal, ceteris paribus. So what it says is that if you think about price, we are determining the price at which we're going to buy by looking at what's available and how much of it we can buy depending on the product. So volume may play a role because price may dictate what volume we purchase at or what volumes we purchase. So the law of demand. Law of demand is very simple. As the price of a product rises, we will buy less. As the price of a product falls, we can buy more. So therefore, on the demand curve, there's always an inverse relationship between price and quantity. All other things being equal again, ceteris paribus. If the price goes up, we'll probably buy less. Again, the chocolate chip cookies, $2 to $2.50. And if the price goes down, if I can get chocolate chip cookies for $1.50, I may be inclined to buy 2 boxes of chocolate chip cookies. Therefore, we explain the inverse relationship between price and quantity on the demand curve as being essentially what our price points are based on what we think we should pay for it and any limitations we face, which we'll explore further in the chapter. So here it is in graphics. When the price goes up, the quantity goes down. That's the law of demand. When the price goes down, the quantity demanded goes up. Now this relationship is the relationship between price and quantity. Again, the relationship is used to define what happens in the marketplace in terms of microeconomics between buyers and sellers. It's also used to determine what's going on in the aggregate economy, the price level for the economy, and the output or GDP for the economy. So it's a critical concept in economics. It applies in many, if not all, situations. All right, so let's explore further the inverse relationship between price and quantity. And let's look at what factors cause that to take place. First of all, we can explain it through common sense. Again, my chocolate chip cookies example. You'll probably get sick of me talking about chocolate chip cookies, but it gives me a good example to relate to you the different operations and actions and reactions that occur in a marketplace. So if I buy 1 box of chocolate chip cookies, okay, I might buy more in the example I just quoted if the price goes down. I'm going to buy less if the price goes up. And as a matter of fact, I'm going to go look, as we said, at other manufacturers of chocolate chip cookies and their prices. And I'm also going to look at substituting something else, sugar cookies, oatmeal cookies, etc. So common sense kind of dictates the demand curve and the interaction of prices between supply or quantity and price. Secondly, the law of diminishing marginal utility. Be careful of this one. Too many people confuse this with diminishing returns. Diminishing returns pertains to a business, a firm, and we'll explain that when we talk about supply. But essentially what I'm saying here is that we get diminishing marginal utility pertains to satisfaction. Always satisfaction. It doesn't relate to anything else. We get a lot of satisfaction from the first box of chocolate chip cookies we buy. We don't get as much satisfaction from the second box, probably because we're full. And that example is the law of diminishing marginal utility. I'm getting less and less satisfaction from the chocolate chip cookie box, the second one that I buy. Now, grocery stores, as we said, understand this concept more than anybody else. If a product is on their shelf and it's not selling, the first thing they'll do is try to get rid of it and clear the shelf space. Again, grocery stores operate on a very small profit margin, usually 1 to 2%. So what they'll do is, since they're stuck with the manufacturer's suggested price, and the manufacturer doesn't want them to see below or price it, sell it below that price, what they do then is they offer specials. They may even price it higher, but what they'll do is they'll offer the chocolate chip cookies, buy one, get one free, or buy one, get a second box for 50% less. That's how they clear their shelves, and that's how supply and demand kind of works in a grocery store. Even though we don't meet face to face with the manager of the store or the owner of, say, Kroger, we are negotiating price and quantity when we go to the store and we buy something. In most cases, we accept his price. Okay? Inverse relationship further. The inverse relationship is also explained by income. Our ability to pay is key in what we're going to buy. So if we have a lower price, we have experienced an increase in purchasing power. Gasoline, for instance, now it's about $2.59. It was $2.20. Okay, we're going to slow down our purchase of gasoline at that price and wait for the lower price. Right? We may not fill up the tank. We may just do half full, because we know that price is going to come down. It can't continue. It will not continue. As more and more supplies hit the market, the price will start to drop. As more and more plants that produce gasoline come online in that hurricane area, the more the product will flow into these local gas stations. So if we with a lower price, we haven't experienced an increase in income at all. Our income stays the same. But what has changed is our ability to buy more stuff. So what's happened is that our purchasing power, by a reduction in the price, has improved. We've got more money to spend. If the price goes up, our purchasing power is declined. We have less money to spend. Substitution effect. We talked about this. Example we can use, and this has happened quite a bit recently. The price of steak has gone through the roof, and what's happened is people have substituted steak for chicken because the price has gone too high. They're both acceptable products. They have almost, if not a perfect, substitution effect between each. And what will happen is that we will substitute steak for chicken as our staple. And in effect, what we've done is we've forced a change in pricing. What's going to happen, for instance, to the price of chicken as we continue to buy more? Well, obviously, more purchases is going to drive the price of chicken up because the quantities demanded will increase and suppliers will have to react to that increase. And in reacting to that increase, their costs will go up and they'll have to raise prices. The opposite effect will happen to steak. Steak will start to drop because there'll be more of it sitting on the shelves and they'll have to move it. So there's always, what I'm describing to you, the substitution effect always creates a balance between products that are substitutable. We as consumers, again, consumer sovereignty, what we buy with our dollar votes, the price of steak and the price of chicken are directly affected by our actions. Okay, okay, understanding graphs. Now, in this class, I don't want you to know how to draw graphs, and there won't be graphs on your quizzes. There'll be multiple choice and true false as we've done so far. But you do need to understand the graphs. And a lot of students that do well in my class have gotten into the habit of using that piece of paper I give you with the questions on it and doing graphs so that if they have a question on, for instance, the demand curve, they may draw the graph and see what the answer to the question is based on what they've drawn on the test paper. So you need to understand graphs. I'm not going to make you do graphs in your tests, but you do need to understand how they work and how to build them. So, demand curve, once again, inverse relationship. As the price of product goes up, the quantity purchased will decline. As the price goes down, the quantity purchased will go up. Can't say that enough. Let's talk about the supply curve, though. We're going to talk about that in a minute once we finish demand. But the supply curve is different than the demand curve. Where the demand curve has an inverse relationship, price goes up, quantity demanded goes down, and vice versa, there is a direct relationship on the supply curve, which means that as the price goes up, the quantity produced will increase. As the price goes down, the quantity produced will go down. Now, the inverse relationship describes the consumer. The direct relationship describes the producer, those who build, make, and sell the products. So what he's looking at, a benefit to him is an increase in prices because he can make more money and sell more product. So his schedule or his curve has a direct relationship between price and quantity. Price goes up, quantity produced will go up. Price goes down, quantity produced will go down. Okay. And by the way, as that price goes down, he will have to cut back on production, which will have an impact on employment at his firm. One last curve that we often talk about, and I think I've drawn the relationship with Apple and how they started with the iPod, developed it into an iPhone, iPhone 4, iPhone 5, iPhone 6, iPhone 7, and the new releases that are coming around I think the 20th of September or so. Anyway, in September, in time for the Christmas buying season. That's when Apple typically releases new products. Now, what we described in those products is a nonlinear curve, or what we call a bell curve. So in this class, we primarily deal with the demand curve, the supply curve, and the bell curve. The bell curve depicts a product's life cycle. It starts out small, quantities being purchased. It takes off in the marketplace, grows to a peak. It hits that peak and then starts to decline because people don't use it anymore. It's fallen out of favor. It's not important to the product. Another product has come along and replaced it, etc. All kinds of things can happen to a product and to a company, particularly a company that has a single product. They may not survive. Here's the demand curve and shows the inverse relationship. The price of $30, let's say, we'll buy 5. At a price of $24, we'll buy maybe 7 in this graph. At a price of around $17, we'll buy 10. $15, we'll buy 16, 17. $10, we will buy 23 or 24. And lastly, at almost $5 where we started, we will buy 30. So this depicts the inverse relationship between supply, between price and quantity, and this is our demand curve. It's always downward sloping and to the right. Remember that, downward sloping and to the right. Now there are movements along that curve. This example, this product is purchased at $3,000, let's say. And the quantity demanded is in millions. So the price we're used to paying is $3,000 and we'll buy 5 at $3,000. If the price goes up to $4,000, we will cut back our purchase to 4 units or 4 million units. If the price goes down to $2,000, we're going to buy 6 million units. So a movement along the curve represents what quantities we will buy. A higher price, less quantity, a lower price, more quantity. So this is a movement along the demand curve, and it's the marginal change. It's like the chocolate chip cookie example I gave you. Increase in price from $2 to $2.50 is like that movement up the curve. Okay, we're thinking at the margin. 50 cents more is ridiculous. I'm not going to pay 50 cents more. 50 cents less, I might buy twice as many. Okay? That's the law of demand, and there's an inverse relationship between price and quantity. Next, there's a shift in demand. It's important that you guys know and understand the difference. Okay? A movement along the curve is simply a change in price. A total shift in the curve represents either an increase in demand or a decrease in demand. So remember, one is a movement along the curve, the other is an increase or decrease in demand. And what we're going to talk about in a minute is what causes that curve to shift. What makes the demand curve shift? And the example we have here at $4,000, we'll buy, if the standard curve is demand 1, in this example, we'll buy 5 million units. If we have a reduction, say in income, we will buy less or 4 million units. If we have an increase in income, we might buy more or 6 million units. We'll talk about that now. So, market demand shifts. What causes it? All right. This is really what happens in the marketplace for demand shifts is really based on the actions of us. What's influencing us? In other words, again, we are the key people. We're the consumer, and we're buying the product. Hang on a sec. Because of certain things. All right, first of all is taste and preference. If we have a preference for a particular product, we're going to move into the direction of that product. Typical example is the evolution of the microchip. We started with huge PC towers. We then went to laptop sales, and of course the PC towers fell off the bell curve. The next was laptop sales. They had the increase. All of a sudden now we've got tablet sales. So these are all tastes and preferences that have occurred over time. They didn't substitute one for the other. They evolved as products in the marketplace, much like Apple has done with the iPad not the iPad, but the iPod, into the phone, into even iPads and other products coming down the pike probably in September. All right, so taste and preferences explain demand shifts. In the example we used in the PC towers, the demand curve completely dropped, reduced, but the demand curve for laptop sales had the increase. All right. Second thing that can influence the market shift is the number of buyers. So an increase in the number of buyers may have an increase in the demand for the product. Now, here's the question. how do we know, or how do we get more buyers in the marketplace? What happens to us? There are only so many people in the world or in the country that are, say, buying a product. So the only thing really, if you think about it in macroeconomic terms, the thing that influences the number of buyers, for instance, and how we increase the number of buyers is through immigration. More people come into this country. In the long run, an increased birth rate produces more buyers. The short run, immigration. All right, and lastly, income. This is probably the biggest determinant of shifts in the demand curve. An increase or decrease in income will have a tremendous impact on how we buy and what our buying habits are. For instance, a shift in shopping from Target to Nordstrom. We may have had a decrease in income, and therefore we're going to buy products at a lower price in a wholesale house like Target, Walmart, Costco, etc. This shift, in effect, actually did occur in the Great Recession, with the onslaught of the Great Recession, 2007, 2008, 2009, etc. People had substantially reduced income because the unemployment rate went from roughly 4 or 5% all the way up to 10%. When people are nervous about their jobs, when the stock market has declined dramatically, when they have lost value in their homes, they will pull back and pull back tremendously. So what happens is Nordstrom gets less business, Target gets more. Saks Fifth Avenue gets less, Target, Walmart get more. This is the income effect on the price and quantities demanded on the demand curve. And this is what causes a shift. It actually did occur in 2008, 2009. It's tending to come back now as our unemployment rate has dropped. But the American consumer has a pretty good memory. And a lot of people are concerned that part of the problem with bricks and mortar companies going out of business or cutting back on the number of stores like Sears, Nordstrom, etc., is a result of the attitude that we have about money since we were dealt such a severe blow in 2008 during the Great Recession. We'll explore that concept a little bit further in the class. All right, market demand shifts. Price of related goods can affect the demand. For instance, the dollar drops dramatically. That means that our products become very, very attractive to foreign buyers. Okay. It also signals the world that the number one economy in the world may be in trouble. So investors worldwide may say, oh, the dollar is dropping, which is happening right now, by the way. So we better move into gold, which is actually what's happening now. The dollar has dropped dramatically in value versus other currencies in the world. And the purchases of gold have increased dramatically in the last couple of weeks. This is happening right now as we speak. An example again, second example, back to our example of substitution between beef and chicken. Okay. Chicken prices are reasonable, beef prices get out of control, we shift to chicken. The equilibrium seems to attempts to reestablish itself because the price of chicken will go up as we buy more, the price of beef will come down as we buy less. Same thing with the substitution effect of coffee versus tea. 3 or 4 years ago, coffee prices increased dramatically. Starbucks raised their price 10, 15 cents per cup of coffee. People did start to move into tea. It's interesting to note that the coffee price since then has come down, but Starbucks has not reduced the price of their coffee. Price of complementary goods. This is a complementary good is something that is sold because of some other product. You have to have it. It goes along with it. You can't play tennis without tennis balls. So tennis racket sales may influence the amount of tennis balls being sold. Just like the example I give you here, if let's say the price of a round of golf goes up dramatically, sales of golf clubs may decline because we'll stop going to the golf course and playing golf because it gets too expensive. In fact, this did happen in 2008, 2009. Golf memberships, private clubs dropped dramatically because people were scared. People didn't have as much money. Again, unemployment went to 10% of the working force, and it resulted in big changes in golf courses and golf course management. All right, here's an example that we used in class. I was teaching in class in 2016 in the fall. And you'll remember this probably because a lot of you, well, we all have cell phones now. Okay. U.S. Consumer Agency said stop using Samsung Galaxy Note 7 because their batteries are blowing up. Shut them down and don't charge them. That was huge, a huge impact on Samsung. The reason was there was a chance of fire in the lithium-ion battery in the Galaxy Note 7. The South Korean company, Samsung, identified in their inventory by various tests what was bad and got it out of their inventory, and they stopped shipments and they recalled the products that they had sold. So virtually cell phone sales at the South Korean company Samsung stopped dramatically. So we apply the law of supply and demand and we apply it to the stock market. We actually did this in class, speculated what was going to happen on the price of stock since Samsung was hit dramatically because of this problem. And what actually did happen, what we projected in class, the students and myself. Sell Samsung stock and buy Apple stock. That was a good bet. If you didn't have Samsung, you didn't want to buy Samsung, you didn't have to. All you had to do was move into Apple stock because there would be a big increase, and in effect there was, in Apple stock. Now, why did that occur? Because product substitution, even though we may have preferred the Galaxy 7, we needed a cell phone. So we substituted the 7, the Apple iPhone, the 6, or they even had this. Now they didn't have the 7 out then, but they had the 5 and the 6. We substituted those for any Note 7s we couldn't get. It was off the market for quite a while. So buy Apple stock, price goes up, we make a good investment. If you want to speculate on the stock market, what you need to look for is situations like this that occur where you know exactly what's going to happen based on the laws of supply and demand. Okay, graph of time series. This is a demand curve. Price is 10, quantity will buy is 0. That bottom number 1 should be actually 0. At a price of 0, we'll buy as many as we can. So chart the curve, do this at home, practice, take out a sheet of paper, make sure you understand the inverse relationship between price and quantity and can draw the graph. Demand curve has an inverse relationship, as we said, between price and quantity. And that means that consumers will buy more at lower prices. Can't say this enough, and that's what this time series shows. At a buck, or at 8 cents or $8, whatever the case may be, we'll buy 1. 6, we'll buy 2. At $4, we'll buy 3. At $2, we'll buy 4. Okay. Okay, law of demand. Here's a cartoon I came across. There's a lot of talk today about building a wall between Mexico and the U.S. to stop illegal immigration into the U.S. from Mexico. So here's a cartoon about supply and demand. We decide to build a 20-foot border fence, and this enterprising man on the other side of the fence is renting 21-foot ladders so you can climb over the fence. Kind of a cute cartoon. All right, the law of supply. it's different. The law of supply says that as prices increase, producers produce more. As prices fall, producers will produce less. And it makes sense. If I'm running a business and I see the price of my product going up, it means that more and more people are demanding it and they're willing to pay a higher price. So what I'm going to try to do is meet that demand by producing more stuff to sell in the marketplace. The reverse is also true. If the price falls, I'm going to produce less because I recognize I'm in trouble. People are not buying as much, and therefore I have to cut back. Otherwise, I'm going to end up with a pile of inventory that nobody's going to buy. So what do? I lay people off. In the case of the price rise, we'll talk about this later, and the law of diminishing returns, I produce more units, but the new unit I produce has a higher cost. And we'll talk about that later. Okay, most prevalent example is agriculture. Price of wheat goes up. The farmer puts more land into growing wheat. Or the price goes down and they will substitute potatoes for wheat. Now, farmers are kind of unique in this, in that they have the ability to protect the price that they may want to sell at. And the way they do it is they buy and sell futures contracts. Let's assume the farmer puts his wheat in the ground in the spring, plans to harvest it in the fall and sell it in the fall. He sees a price in the marketplace right now. He's going to plant the wheat because he likes the price. What he will do, he will go to an agriculture broker, the co-op maybe, and he will engage in a contract with a broker. The broker will say, I will buy your 10,000 bushels of wheat at X price. They agree to that price, and therefore the wheat farmer knows exactly what he's going to get paid for his crop, and he can proceed on that basis without a lot of risk. Now, there is risk, however. The price could go above what the farmer thinks, and he will not get that higher price. The broker will pay him the price that they've agreed at. The price could go down, and the broker will lose because he has to pay the higher price to the farmer. It's called hedging, okay? And we'll talk a little bit about that later on in the class. All right, manufacturing, it's a little bit different. In manufacturing, we have fixed assets like machinery, labor, okay? And if I want to produce more, let's say I'm producing 10,000 units a year. I see an increase in demand, and what I'm going to do is I'm going to meet that demand by producing more stuff, and therefore I will increase my profits. So what I'm going to do is produce more. Let's say I want to increase my production from 100,000 units to 110,000 units. Well, I'm already fixed with my income. I can't add any more people. I can't add any equipment, more machinery to produce more, because it will take time to get that machinery up and running. And then if I can't hire people to run that machinery right away, I have a problem in the short run. The other thing that happens is that there may not be people out there that I can hire. I may not be able to add that quickly and train people in my workforce. So what do? The obvious thing is I increase my production by increasing the number of hours that my workers work. So in Texas, a 40-hour work week, you have to pay overtime beyond 40 hours. So I increase another shift, or I increase the hours of work, or I bring people in on Saturdays, etc. I just have people working more hours to get more product out, the 10,000 more units that I want. The problem is, what do I have to do to get there in the short run? The only solution is overtime. And as you know, beyond 40 hours, overtime represents time and a half. So it's more expensive to produce those additional 10,000 units than all of the 100,000 I produced before. This is the law of diminishing returns. It operates primarily in the short run. the 10,001 unit or the 100,001 unit I produce has a higher cost on it than all of the 100,000 I produced before that. So make sure you understand the law of diminishing returns. Okay, increases or decreases in supply. Just like demand, we can have increases and decreases in supply as well. So an increase or a decrease in supply occurs with a movement along the curve. Right? A movement along the curve, we see a price increase, so we produce more. A price decrease, we produce less. That is a movement along the supply curve. So we will produce more when the price goes up. We can't hire more workers, as we said, we'll go into overtime. And when we do that, we will trigger the law of diminishing returns. Again, that's how the law of diminishing returns works. That additional units we want to produce are going to cost us more than the whole 100,000 we produced before that. We produce less when the price goes down. How do we do that? All right, unfortunately, layoffs, mandatory vacations, shorter work week, etc. Now, from a producer's standpoint, this is a horrible situation. They do not like to deal with it. And the reason is they've spent money, time, and effort to train their labor force. They don't want to lay people off because they may find another job, they may go to work for a competitor, or they may just leave the workforce and decide that they're going to open their own business, their donut shop, or their dry cleaners, whatever. Okay, so producers hate to do this. A lot of cases, they're maligned by the general public for doing this, but they don't like it either. It's important you understand that. All right, so if we graph it, supply curve, plot the supply curve in the following chart, and this is what it looks like in a time series. So the numbers are, at a price of 10, the quantity is 5. Price of 8, quantity is 4, 6, 3, 4, 2, and so on. And what's happening here, there's a direct relationship. The higher the price, the greater the quantity, as opposed to the demand curve, which was the inverse. As the price was high, quantity was low. Okay? So the supply curve is a direct relationship. The demand curve is an indirect relationship or an inverse relationship. This is what it looks like. Okay? Your supply curve, like your demand curve, slopes always to the right. However, where the demand curve slopes down and to the right, the supply curve slopes up and to the right. Why? The higher the price, the more the producer will produce. Very simple concept. Okay? All right, a shift in supply. What causes the supply curve to shift? Well, we just lived through one. Living through one now, actually, still. Gasoline. The price or the supply of gasoline, if you look at this chart from S to S2, okay, supply has decreased. Now, this chart shows, again, the price of $3,000 and how many millions we will buy. In the case of our gasoline, what's happened is the price has gone up because of a shortage of product. So when the supply curve shifts up, this is a reduction in product availability. When the supply curve shifts down, this is an increase in the quantity available for purchase. Right? That's different than the demand curve. It moves in different ways. All right, what causes these changes or shifts in supply? One, resource prices. If we use a product, let's say a base product like copper in production of our product, copper prices go up, we have experienced an increase in cost. And as a result of that increase in cost, if it's going to last for a long time, or if it's significant, we will be forced to raise our prices. The example of Starbucks and the price of coffee. 10 to 15 cents more for a cup of coffee because coffee prices increased. Technology can cause a shift in supply. Right? Technology, in the case of the Apple products, technology kept building new and more new iPhones better than the one before. And as a result of that technology shift, we moved into and continued to buy iPhones from Apple. Taxes and subsidies. A lot of people don't understand this one, particularly taxes. The corporate tax rate in the US is the highest of most countries in the world. And that puts us at a distinct disadvantage in the marketplace. Because of higher taxes, we have to make a sufficient amount of money to pay those taxes. For instance, corporate taxes in the US are 35%. Corporate taxes in Mexico are 30%. Corporate taxes in Canada are down around 10-15%. So Canada and Mexico, based on taxes, has a decided advantage in NAFTA over the United States in the ability to produce product. I think labor rates are probably lower as well, and that is probably the most significant. But we have a problem in taxes, and the government is currently addressing this today as we speak. The other issue is subsidies. In the case particularly of international trade, governments want to develop a local industry, so they subsidize that industry, and that company or that country is able to offer that product at a lower cost. Okay? We've done this particularly here in the farming industry. We don't want to lose farmers. We don't want to have them stop producing product. So the government steps in and says, all right, if you produce wheat, we will pay you a minimum of $2 a bushel. And therefore, you can continue to produce wheat at current market prices and still make money. All right, prices of other goods have an impact on the shift in product. If Apple were, or let's say Samsung were to come back out with an iPhone, which the new versions are probably going to be around $1,000. Let's suppose that Samsung price there is at $800 to gain market share. That will have a big impact and shift the supply curve for Apple, and it will shift it downward or backward toward less product. Producer expectations. Again, the example we used of the producer who's producing 100,000 units sees an increase in price, decides, says, I'm going to produce 10,000 more because I think I can make more money with those 10,000 units. So he goes out and finds a way to do it, adds more overtime and produces more products. Because what is he doing? He expects to be able to sell that additional product. Number of sellers have an impact. We talked about this a little bit. We referenced it. In a marketplace that's very competitive, you have a lot of sellers. In a non-competitive market, you have few sellers. You can, for instance, have many sellers of soap, but few sellers of diamonds, maybe only one De Beers. Changes in quantity supplied. Again, this is a little bit different in that the quantity supplied could shift because of other factors. We just used the example of Harvey hitting Houston having to shut down their a lot of their wells, but more importantly, their plants that converted oil to gasoline. They had to shut down the pipelines and they had to shut down the refineries, the cracking plants. So we saw this in spades with the result of Hurricane Harvey. All right, what happens when we have a shift in demand and supply? Let's take a look. In this case, demand 1 is the light blue line, supply 1 is the light red line. So what has happened here? Our demand has shifted up from demand 1 to demand 2, and as a result, in response, our supply curve has shifted up as well, even though the curve moves down. So P1 is the price Q1 is the quantity at that high price. When the price drops, the quantity goes up to Q2, and in this case, the price is actually increased. Why did that happen? Because producers have responded to an increase in price by selling more product. Okay? So look at these graphs, spend some time understanding them, and be sure you know the difference between a movement along the demand or supply curve and a shift in demand or supply. All right, commodity oversupply can happen. Wall Street Journal in 9/15/2014. Sugar. Inventories of sugar started to bulge. 7-month low in sugar prices for the 4th consecutive year. And why? Because people are shifting their tastes and their preferences from sugar to artificial sweeteners. There are probably 4 different artificial sweeteners on the market today. Depends on whether you look at the blue container, the yellow container, or what's the other container, orange or whatever it is, pink. Okay? So these guys are started to compete with sugar, and as a result, sugar is a plant and a product in agriculture. And these guys have experienced dramatic changes in their inventories and in their prices. So what happened was the inventory started to bulge, and Brazilian sugar producers started to reduce their output. They scaled back their investments in sugarcane and shut down sugar mills altogether. This is a big shift in a commodity, and this happens often in the marketplace. Okay? Brazil is the low-cost producer of sugar. They were having a boom time 3 or 4 years ago when we were using sugar in our gasoline, but this eventually ended up backfiring. Okay, so let's take demand and supply together. Equilibrium is the point at which demand and supply are equal. We call this equilibrium. And what it means is that we're at a price and a quantity that everybody's happy with. The consumer is happy with the price that he sees in the marketplace on the shelf. The supplier is happy with the quantity he's producing. Everybody's happy. The thing that you guys need to remember about equilibrium is that economists think at the margin. Therefore, equilibrium means that the marginal benefit of the product is equal to the marginal cost. I'll say that again, marginal benefit is equal to the marginal cost. Because we think at the margin, we're happy. Marginal benefit is good. The producer thinks in terms of his cost, low cost. He's happy. His marginal cost is good. Also known at this price as called market clearing. Market clearing means that everything I produce is consumed. I have no excess inventory at the end of the year. I don't have any shortages. So I don't have oversupply and I don't have undersupply. What I produce is completely bought up by the consuming public. So it's called market clearing. So remember that concept. So there are no shortages, no surpluses. Consumers don't have to grapple with shortages. Producers don't have to grapple with surpluses. The last thing a producer wants is a surplus in the marketplace, because that means he's stuck with a bunch of inventory he's expensed or bought or purchased or produced. He's got all his costs tied up in inventory that isn't moving. The same thing with the consumer. We saw the shortages that occurred with gasoline. Not good, not fun. Some of us got caught without any gas. I came in with about 50 miles in my tank into class on Tuesday, and I was fortunate enough, I stopped at 3 stations, couldn't get any gas, but on the way in near Holton City, I saw a 7-Eleven station that was open, no lines. I jumped in there and got my gas. Unfortunately, at that station, they would only allow me to buy $20 worth. Okay, equilibrium of supply and demand. Here's what it looks like. Demand curve, downward sloping and to the right. Supply curve, upward sloping and to the right, right? A price and a quantity that we are happy with. Equilibrium meaning marginal benefit to me, the consumer, my demand curve, and marginal cost to the supplier, his supply curve. We're equal. We're happy. We're really, really happy. No shortages, no surpluses. All right, government setting prices. Sometimes governments step into price setting. And unfortunately, the government, it does not have the benefit of an invisible hand. In other words, there is no marketplace when they go in and they set prices and they decide what the price should be. Can lead to problems. Price control, subsidies, rent controls, and black markets. The unintended consequences of government intervention in the markets can have some serious problems. For instance, establishing a price level for a product or rents or interest that is too high or too low can result in shortages or surpluses of that product in the marketplace. Now, we said consumers don't want extremely high prices, producers don't want extremely low prices, so it's a detriment to everyone involved in the marketplace. Now, it's impossible for the government to find the equilibrium point. Why? Because they do not have the benefit of an invisible hand. They do not know, for instance, what the four functions are: price, quantity, demand, supply. They're putting their signature on something that they really don't fully understand and can't possibly understand. All right, the price, if they set the price too high, a black market can develop. Too low, shortages develop. Remember the example I gave you of cigarettes in New York City, priced out of the market, $2 a pack. The smart guys filled up trucks down in Virginia with cigarettes, brought them back up to Manhattan, up to New York City, recruited kids out of the inner city, and those kids went on the street corners and started to sell black market cigarettes. Right? Since it was a law, the police had to enforce that law. And in one case, a young man was selling cigarettes on the corner. The police got a little bit too overly reacting for people, for one cigarette salesman. He was put in a chokehold and died. That did not have to happen. That is the direct result of government interfering in the marketplace. And that was an unintended consequences that didn't have to happen, and somebody lost their life. Now, I experienced the supply and demand problem when I worked for a company called Fairgain. We developed a product that we sold to telephone companies where we could take a single pair of copper wire, which is an analog system, put a converter box on it in the person's home, and we could add 3 more lines to that copper wire that was limited to 2. Now, limited to 1 rather. So we were able to increase the capacity of phones over a single pair of copper wire. If anybody knows this system or what it was called, it was DSL was the code word. Now, the telcos merged and demanded lower prices because, well, you remember what happened. We had 7 sisters when AT&T was split up. We had Bell South, we had Pac Bell, we had New York Telephone, etc. So 7 different Bell companies, Bell operating companies. But what's occurred since then is they have merged. We're now down to maybe 3, Verizon being a very big one. Verizon is a provider in our area. So when they merged, they said to companies supplying product to these telephone companies. You know what? We were one company before, now we're two. So as a result, we want a better price from you guys. Okay? That's what they told us. Our CEO, having a very large ego, told the telephone companies, well, you know what? You really don't want a lower price from us because our high margins enable us to invest in technology and we can make better and higher performing products for the telcos. The purchasing managers and directors at the telephone companies like Verizon said, go away. You either reduce your price or we're not going to buy product from you. He wouldn't change. The end result, we lost all of our business to the only real competitor. He came in and agreed to a lower price. He agreed to a lower price and his quantity produced jumped. And because his quantity produced jumped, his cost went down. He took a risk and he won. Our CEO lost. The company was sold a few years later to not Alcatel, but another telephone company, and I don't think it's even in business anymore. Bad situation. What you have to do in life, you have to understand economics. You have to understand what is going to happen as a result of what you do. For your action, there's going to be a reaction. So make sure you do actions that result in betterment for you and your company. All right, we'll stop there. And let me put this on hold.